Well, the bar is high for NVIDIA, and my next guest says it's also getting higher for the Fed to cut by 50 basis points next month. In fact, she only sees 2 cuts total this year, each just 25 in September and December, less than the 4 cuts that the market is betting on. But it's not because of her confidence in the economy. She sees a bifurcation that has her playing a bit of defense. For more on what she's seeing and how she's positioning, I'm joined by Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Victoria, great to have you.
My pleasure.
Okay, so no 50.
No 50. I think there's too much, as you mentioned, bifurcation in this economy. We've seen it in the consumer for quite a while. The low-income consumer and now even the middle-income consumer really struggling. It was that high-end consumer kind of holding things up. And then as we went through retail earnings, we saw how now even the high-end consumer is starting to move down the spectrum in what they're spending and where they're spending. Walmart being a perfect example of gaining that share, because higher income consumers are looking for bargains, looking to see where they can get all those $5 deals we're hearing about everywhere. And then look at the data that's coming in, John. Lots of bifurcation there as well. Capital goods, take out transportation, that was negative. We're seeing contraction in business spending. We're seeing contraction in some of the elements that feed into GDP. So I think we have to be a little bit cautious here, even though the idea of rate cuts coming at the next meeting is kind of buoying the stock market.
So if we're getting all that contraction, why isn't that a signal that the Fed's job has been mostly done so they can maybe more dramatically ease off right now so that the economic signals, which have been mixed, don't get worse?
Yeah, I think that's why they want to take their time. I think that's why they're being very cautious in how they're signaling what their plans are going to be. 25 makes a lot of sense for this first cut. We are not in a recession at this point in time. We actually thought we would be by now, but the consumer has held up strong enough in order to sustain the economy. So we're not in that recessionary time. We are making a cut now, and the lags are going to be there. I just don't think they want to get ahead of themselves, cut too much, and then fan the flames of inflation by getting demand stoked higher than where it is. So I think they're going to take their time.
So what does that mean for stocks if the market's expecting 4, only going to get 2, especially the small caps?
Yeah, it's the big call here, and I think you have to kind of look at what this leadership is looking like in the market. You look right now, we are looking at things like financials, healthcare, utilities. These are things that are leading the market. You know, financials, you've got almost 90% of that sector above their 20-day highs. Taking a little bit more of a defensive tone, looking at companies that have good dividends, good balance sheets, solid earnings. This is a defensive play for the market. So you want to be in there, you want to take advantage of things, but I think the sectors we're starting to see are a little bit more defensive in play, and that's where you need to be.
Why is defensive right this time? Because a year ago, right, we were hearing a chorus. Every time the market takes a dip, it was okay, now it's time to go defense.
Right.
That was the wrong move. If you had stayed, even just with the general S&P 500, but certainly stayed with the mega caps and the names like NVIDIA, you would have done much better.
I think the key here, and like what we're doing for our clients, is really it's that diversification. We have exposure to still those Mag 7, right? We have exposure to NVIDIA, to Microsoft, to Amazon, to these names that are there. We're underweight, but we still have that exposure, so you have the ability to capture some of the upside in the market. But take some of the winnings that you've had, take that off the table, put some in fixed income, get a good cash flow. I can go short on this treasury curve and still get 4 to 5%. That seems like a no-brainer to an extent. And then put some of that cash in the defensive play. We've been trimming our tech all year and using those source of funds to go into these areas. I think that gives you a more balanced portfolio for some of the volatility, because it's not just the stock market. We got a few other things that could cause some volatility from now to the end of the year.
Based on the questions and maybe suggestions that you get from clients, what has happened to investor psychology over this period of time where we've had these big, well-known names with a lot of products that people understand, maybe NVIDIA accepted, doing so well? And, you know, if you were in bonds for a long period of time, you felt like a sucker.
Well, I manage taxable fixed income, so we don't want to say that they're suckers. They're getting that steady, consistent cash flow that they need.
But if you were too much in bonds...
But if you're too much, absolutely. Not that you want that 60-40 portfolio per se, even though we did see today that that's doing quite well. I think you have to have that diversification in your portfolio, have a little bit of that fixed income. But clients are looking at it and saying, in the long run, I still like a Microsoft. I still like an Apple. NVIDIA is going to continue to do well. We know AI, it's a secular theme, but it has a very long runway here that we're going to see some advantages from. And maybe look at some of the secondary companies that might do well from AI, not just the ones we're seeing right now. I think that's how you can play some of the questions that are coming in from clients.
I'm old enough to remember 20 plus years ago, early 2000s, really right up through the financial crisis, a lot of the market did absolutely nothing for almost a stretch of a decade.
Right.
And it was maddening for investors. Right. Do investors today have the stomach for sideways?
Well, hopefully they do, because I think we'll probably be in that element for a while. And I don't think we're just going to be sideways. I think if you take a point in time and we look out so many years and then we see where we are, maybe it looks like it's sideways. I think there's going to be extreme volatility. So they're going to need a stronger stomach, I believe, than what we saw before because of the concentration that we're seeing. Bob Pisani was just talking about, NVIDIA being 6% of the index, and it's the same as whole sectors. So lots of volatility that can come. Clients need to be able to work their portfolios in a way that gives them some confidence and gives them the ability to handle all of that.
Back to measuring patience in years rather than weeks, maybe. Victoria, thank you.